Chris, good to see you. We've done a fair bit of work, I guess, that needed to be done on the downside. You would expect, S&P down just about 20%, not quite. Nasdaq down 30%. I think the average Nasdaq stock down 50. S&P multiple from 22 to 16 and change. Is it enough?
I think so. So today, Mike, something about today, and maybe it's just a feel. I'm not really sure. But today, I'm actually encouraged for the first time in a long time. You're right, we're off the lows, but more importantly, the market's beginning to discriminate. In addition to that, you're beginning to see rates react. Rates are going down. And one of our mantras and one of our comments is when equities go down, usually stock prices and bond yields don't go down together forever because it's a self-correcting mechanism, right? Stocks go down, you start to create more value, bonds go down, and your discounting mechanism makes your terminal value higher, and all of a sudden we find a bottom. And that's what we're beginning to see. Also, you're getting encouraging news out of the JP Morgans of the world. You're getting encouraging news from some of the Fed officials. Yesterday they talked about, or maybe even today they talked about, hey, when we get to 2%, maybe we need to look around. We need to think about what we're going to do going forward. We need to see if inflation expectations are coming down. And they are beginning to come down. So I'm actually encouraged for the first time in a while. We still tell people to buy stocks, not the stock market. But I think this price action, even though we are down over 1%, is actually encouraging.
Would you hope to see, some of the other, I guess, sort of dominoes fall in this process of trying to kind of make the market outlook more realistic, such as earnings estimates being cut down, or even, you hear a lot of people saying they would want to see another climactic flush lower or something tactical that says that we've gotten to further extremes?
So Mike, coming into this year, we were at 47.15. So coming into the year, we were third or fourth lowest on the street after being the bull on the street last year. And we were expecting a 10% correction. We got that and more. And the reason why we were somewhat negative coming into the year is we thought you needed multiple compression. You got that. We thought interest rates, and especially real rates, needed to normalize. You got that. We thought that the Fed had to get in motion, whether it's related to the balance sheet or it's related to raising rates. That's been happening. And now with that 15, 20% pullback, depending on what part of the market, you have uncovered value. And the two last things we needed to see rates come down, and we needed to see some softening of the Fed rhetoric, which is what we seem to be getting in the short term. So I think there's a lot more value out there. It is actually encouraging. It's actually encouraging because you're not also seeing indiscriminate selling like you were for a few days over the last couple of weeks. And that's telling me that things are getting better. And your last point about some sort of cathartic puke or some sort of big washout day, one of the things we will point to is MSCI's rebalancing at the end of the month, end of the quarter. And if you have the opportunity or if you need to reposition, that's the time to reposition. So I'm not quite sure you're going to see another big volume day because there's going to be a massive volume day on the 31st. And if you have to reposition your book, and some people do, that's the time I think it's going to occur.
Yeah,
that's
that rebalance,
next month.
It's going to affect a lot of different types of portfolios. But what specifically do you think the opportunity, is going to be that's created?
Well, a couple things. So we are seeing the momentum index rebalance, and it's just a wholesale change. What you're beginning to see is more the defensives become Mo stocks. You're beginning to see energy become Mo. And I think the real opportunity is with energy. I think there's a spot for energy in a lot of portfolios, whether it's an inflation hedge, whether it's because they've improved their balance sheets and they are more quality, or because they're one of the few sectors where you're seeing margins expand, not contract.